What happens when the world's largest search engine clashes with governments around the globe? Spoiler alert. Google's stock could feel the heat. Let's dive into the high-stakes world of government regulations and how they can make or break Google's stock price. This is the story of the impact of government regulations on Google. Government regulations are the rules that governments impose to control industries, protect consumers, and ensure fair competition. When it comes to tech giants like Google, these regulations can seriously affect how they do business, and ultimately, their stock price. For Google, it's a delicate balance. The more governments regulate, the more it could cost the company. And investors? Well, they're watching closely. Google faces various regulatory challenges around the world. From antitrust lawsuits in the US to strict data privacy laws in Europe, every legal battle has the potential to shake up the company's stock. Let's start with antitrust cases. Governments accuse Google of dominating the search engine market and suppressing competition. These cases can result in hefty fines, and even force Google to change how it operates. And don't forget Europe's infamous Google tax. Countries there want Google to pay its fair share on profits made through digital advertising. So, how does Google's stock react to these regulations? It's all about the risk. When investors hear about new investigations, lawsuits, or regulations, they worry about how it might hurt Google's profits. Fines, restrictions, or breaking up parts of Google's business. These are the kinds of things that keep investors up at night. But wait, sometimes, Google's stock can rebound. If the outcome is more favorable than expected, or if Google manages to settle cases without major disruptions, the stock price can recover. Let's look at some real-world examples. In 2018, Google was hit with a record-breaking $5 billion fine by the European Union over antitrust violations. That caused a dip in the stock, but guess what? Google bounced back shortly after. Turns out, even a $5 billion fine is just a speed bump when you're Google. But not all cases end smoothly. In the US, the Department of Justice's antitrust investigations loom large, and if things go south, it could mean more than just a fine. It could lead to significant changes in how Google operates. So, how does Google handle these regulatory storms? Well, they've got some tricks up their sleeve. Google spends billions on lobbying efforts, working behind the scenes to influence regulations in their favor. But that's not all. Google is also proactive in adapting to new laws. Whether it's changing how they track user data for privacy or adjusting their ad services to avoid monopolistic accusations, Google is always looking for ways to stay ahead. In the long run, government regulations can have both short-term and long-term effects on Google's stock. While fines and investigations may cause dips, Google's ability to adapt and innovate often helps it weather the storm. For long-term investors, regulatory challenges are part of the landscape, but so far, Google has proven its resilience time and time again. As technology continues to evolve, so will the regulations around it. Data privacy and digital markets will be the battlegrounds of the future. And you can bet Google will be at the center of it all. For investors, the key will be keeping an eye on how well Google can balance innovation with regulatory compliance. The stakes are high, but so are the rewards. Thanks for watching. If you enjoyed this deep dive into how government regulations impact Google's stock, don't forget to like, subscribe, and hit the bell for more insights on tech and the stock market.